Section 899, the revenge tax that could shake global investment. Buried deep within the massive One Big Beautiful Bill Act of 2025 is a single section that has triggered concern on Wall Street, in foreign capitals, and among international investors. That section is Section 899, unofficially nicknamed the revenge tax, and it could radically shift how the United States responds to international tax policies. What is Section 899? Section 899 gives the U.S. Treasury broad authority to increase taxes on foreign individuals and companies if they are from countries that impose discriminatory taxes on American businesses. These discriminatory policies include digital services taxes, DSTs, targeting large U.S. tech firms, undertaxed profits rules, UTPRs, introduced through global OECD tax reforms, diverted profits taxes, DPTs, aimed at corporate profit shifting. If the Treasury designates a country as engaging in such taxation, its citizens and companies could face steep tax increases on their U.S.-sourced income. How the revenge tax works under Section 899, the U.S. government could raise tax rates on U.S. source income, such as interest, dividends, royalties, and rent, by 5 percentage points per year, up to a maximum increase of 20 points. Remove long-standing tax exemptions for foreign governments and sovereign wealth funds. Expand the BEAT tax, base erosion and anti-abuse tax, to apply to more foreign-owned U.S. companies. Apply higher taxes even to real estate gains and business profits connected to the U.S. market. This is a dramatic escalation, one that could punish foreign investors simply for living in countries that have enacted their own tax rules targeting global companies. Who could be targeted? A long list of countries might fall under scrutiny due to their existing or planned tax regimes. These include France, Germany, Italy, Spain, and the UK for their digital tax policies, India, South Korea, and Japan for their own versions of UTPR, Canada, Australia, Mexico, and Brazil for ongoing tax enforcement measures. Any of these nations could be officially designated as discriminatory foreign countries, which would make their residents subject to enhanced U.S. tax treatment. Potential consequences for the U.S. A potential drop in foreign investment, especially in U.S. bonds and equities. Increased borrowing costs for the federal government due to reduced global demand for U.S. debt. Potential retaliation from affected countries, sparking trade or tax disputes. For foreign investors, higher taxes on U.S. based assets could make investing in America less attractive. Possible capital flight toward countries with lower or more stable tax regimes. Growing uncertainty about the stability of U.S. tax policy for non-residents. Where the bill stands, the One Big Beautiful Bill Act, including Section 899, has already passed the House of Representatives. It is currently under consideration in the Senate, with heated debate expected due to the section's potential international consequences. If the full bill passes both chambers and is signed into law, Section 899 could take effect in early 2026, giving the Treasury wide latitude to implement retaliatory tax increases. Final thoughts. Section 899 represents more than a tax change. It's a bold political and economic move. It's a signal that the United States is prepared to fight fire with fire when it comes to international taxation. Supporters say it protects U.S. companies from unfair foreign treatment. Critics say it risks triggering a global tax war and undermining the trust of international investors. One thing is clear. If implemented, Section 899 will be one of the most aggressive international tax policies in American history.